The RBA just hiked interest rates to 4.10 and the media is screaming that the Australian property market is just about to collapse. Well, if you turn on the news today, they'll also tell you that the Middle East oil shocks, the stubborn inflation, the 4.1 cash rate are going to destroy your borrowing capacity and tank housing prices. They want you to believe it is the worst possible time to be a property investor, but they are completely wrong, and I'm gonna just prove it right now. The 2026 property crash is a lie. So what we are actually seeing isn't a national crash, but a great market split. A multi-speed market where some cities are stalling out while others are quietly making investors absolute fortunes. Therefore, if you know exactly how to read data, the next 3 years represent one of the greatest opportunity windows in Australian history, as long as you can block out the headlines. Today, we are going to go and expose exactly where the market is heading over the next 3 years. So first, we'll break down the brutal reality of this 4.10 rate hike and the oil shock. Second, I'll reveal the two-speed market playbook, showing you exactly why I'm ignoring Sydney and piling into cities like Perth and Brisbane. And finally, we look at the 1.1% rental vacancy crisis and how you can capitalize on it right now. So if you're a seasoned investor or just trying to get your foot in the door, you cannot afford to miss this. By the way, guys, if you guys don't know, my name is Lucky Velasquez and I run an award-winning buyers agency recognized specifically for innovation in property investment, and I am an MPA top 100 mortgage broker, and I spend my life analyzing the data so you don't have to. Let's dive in. Let's start first with the elephant in the room, the RBA, the Reserve Bank of Australia. So in March 2026, the RBA raised the cash rate by 25 basis to 4.10 in a tightly contested 5-4 split decision. Why did they do this? Because inflation stubbornly re-accelerated 3.8%, and the primary trigger for this inflation wasn't you buying too many copies, it was the global energy shock. The conflict in the Middle East has created massive disruptions. You know, I know it is threatening to push now oil prices to $150 a barrel, and I'm feeling it, and a lot of you guys are, unless you own an EV, obviously. This creates a massive spike in transport and fuel costs, which bleeds into every single thing we buy. Therefore, the RBA panicked like they usually do and used their only blunt instrument, interest rates. Now, if you listen to the mainstream media, this is where the property market ends. But I want you to look at the heavy data, and what we looked at is the heavy data coming from SQM Research. Lewis at SQM Research did slash his 2026 forecast because of the conflict, warning that high interest rates are going to squeeze mortgage affordability. He noted that an average new mortgage holder in New South Wales is now facing massive jump in monthly repayments. Because of this, SQM predicts that Sydney could experience a price fall by -2% to -2% up to -6% this year, and Melbourne could fall by -1% to -4%. Citing Lewis Christopher specifically from SQM, specifically pointed out that Sydney's economy relies heavily on the financial service sector, which notoriously sheds jobs during global geopolitical shocks. So, sounds terrifying, right? Well, you hear -6% crash in Sydney and you want to put your wallet away. But if you don't couple the next headline with the next piece of data, you're going to completely miss the massive upside happening right under your nose or behind your head. So while Sydney is bleeding, other markets are doing something entirely different. The reality is there is no such thing as the Australian property market. There are thousands of micro markets, and right now we are experiencing the great market split. While high-priced cities like Sydney and respectively other parts of Melbourne have flatlined, which showed 0% monthly growth in early 2026, the mid-sized capitals are completely ignoring the RBA rate hikes, and I want to show you what I'm talking about. Take a look at this. Perth property value have surged by unbelievable 22% over the last 12 months, and it's adding over $22,000 to the median dwelling value in a single month. Brisbane is also up by 17.3%, and Adelaide is also up by 10.9%. Now, why are they booming while Sydney stalls? Because of extreme scarcity. Advertised stock in Perth is sitting almost 50% below its 5-year average. Brisbane listings are down 31%. So you have thousands of seasoned investors and first-time buyers competing for a tiny handful for property. Furthermore, resource-heavy states like WA and Queensland are far less sensitive to the RBA's servicing constraint than Sydney's financial sector from an economic point of view. Now, if you look at the 3-year forecast from Oxford Economics, they predict Perth will actually grow by a massive 30% by 2027, Brisbane by 19%, and Darwin by 24%. Therefore, my strategy and our client's strategy is very clear and simple. I'm completely ignoring the top end of Sydney and Melbourne. I'm opportunity hunting in markets where tight supply, affordability, and high demand create a concrete floor under these prices. But here is the hard truth. You cannot just blindly throw money at Perth or Brisbane or Darwin, etc. and expect to get rich. Finding a high yield, high growth property in a multi-speed market requires extreme precision. You have to know the exact pocket, exact street, the exact zoning. And if you buy the wrong assets, irrespective of where it is, the 4.1 holding costs will eat you alive. Again, thank you, RBA. That is exactly why we've won awards around the topic. We do specialize in innovation for investors, and we use hardcore data to find exact regional, mid-sized capital opportunities that are immune to RBA's rate hikes. Now, if you're using your own BA, great, or your own broker, awesome. As long as they understand what they're doing and they are granular with what they're doing, then good. Now, if you are a seasoned investor wanting to expand or a beginner looking to get into the market safely, click the link below and just book a nice chat with us. We'll walk your hand in terms of what areas you should look at and what structure you should go to. Now, if you prefer to learn the blueprints yourself, you could also just put your email below. There should be a link, and we send you our weekly newsletters regarding what we find over the week. And because right now there's a lot of changes that's happening, probably good to kind of get updated. Now, capitalizing on this decoupled market isn't just about finding capital growth, it's about surviving the holding costs. And that brings us to our third and final pillar, the rental crisis. The media loves to talk about interest rates, but they are completely ignoring the supply side disaster that's happening in the rental market. And if you're a renter, you know what I'm talking about. So again, according to the latest SQM research data, the national residential vacancy rate has plummeted to a brutal 1.1%. In Perth and Darwin, the vacancy rate is just 0.6% because there is simply no housing supply and rents are absolutely exploding, and migration is also up. National combined rents are up 6.6% year on year, with the average weekly rent hitting $688 in Perth alone. Rents have jumped 5.5% over the last 12 months, and in Darwin, they are up a staggering 12.7%. Why does this matter to you as an investor? Why should you know this? Because high interest rates are terrifying if your property doesn't generate cash flow, right? But again, in a multi-speed market, you can target, there's still high yielding properties that offset the cash rate. And if your structure is good, offset something else like tax. So while gross rental yields in Sydney are kind of razor thin, Darwin is generating an average gross yield of 6.14%. Regional areas are holding steady at around about 4.2%. When you buy in a tightly constrained market like Brisbane, Perth, or even Darwin, the tenant demand is so extreme that your rental income grows fast enough to act as a shield against RBA's rate hikes. Also, maybe review your lender structure as well. You get the double-digit capital growth, the two-speed market, which is subsidized by rental crisis, which will grow the yield. So to wrap it all up, the people screaming about a 2026 property crash are looking at the wrong data. Yes, the 4.10 cash rate hurts. Get it? Yes, the oil shock is creating massive global uncertainty, sure. And yes, if you buy a heavy leveraged average property in Sydney or in Melbourne, right now, you might be in for a rough couple of years. And I don't say that lightly. So therefore, you have to pivot. You have to become a hunter for opportunity, but get the right information. So stop looking at national averages and start exploiting, market splits. What that market is doing isn't what this market is doing. Target severely undersupplied markets. There's lots in Perth, Brisbane, Adelaide, Darwin. We use the 1.1% vacancy rate to your advantage by securing high yield assets that protect your cash flow from day one. The smart investors don't stop investing when rates go up. They change where they invest and they structure differently. Now, if you got value out of this breakdown, please hit the subscribe button somewhere here, smash that like button somewhere there, and share this video with anyone who thinks the property market is about to crash. And remember, if you want my team's exact data and the strategy to help you buy your next high yield property, click the link below to book us and have a chat. So stop analytical, ignore the noise, and I will see you in the next video. Hopefully you like that video too. I'll see you guys soon. Take care.